Welcome, everybody, broadcasting live from Salt Lake City, Utah, in Draper today. If for anybody who's local to the area, happy to have everybody along. And usually, what happens with these is, a lot of the marketing we did was on LinkedIn. And what's probably happening right now, and has happened to a couple people, is they're going, clicking the LinkedIn link right now and realizing, oh shoot, I've got to register on Zoom to get into this. So I'll just do a little bit of a song and a dance for a little bit to give everybody a minute or two. But here's what I'd like to do, just kind of ground rules. There is the ability for people to ask questions. There's a Q&A box in here. So what I'd like everybody to do is, while we're getting started, find that Q&A box. So when you have questions, you know where to put them. And just for now, why don't we have everybody put where they're calling in from in that Q&A box? I know it's not really a Q or well, I guess I'm asking the Q and you guys are giving the answer. So, all right, we got a Denver, we got Los Angeles. All right, South Jordan, Travis, good to see you. It's been, I think, a whole 12 hours since we've last talked. Lehi, Utah, really close. Orem, Austin, Texas. All right, my uncle and cousins are all settled in Austin. Pete Turner, I'm guessing that's the Puerto Rico flag. Steve Gilmore, Salt Lake City. Awesome. Okay, so lots of Utah, lots of Mountain West, and then with some Texas. And all right, good enough. So, all right, so what we're going to talk about today is basically where we are in the multifamily market, and not just where we are, how we got there. A lot of people are looking to rate cuts and thinking that, the rate hikes are what got us to where we're at. The rate cuts should reverse things. Okay. I wish it was that simple. It's not, but that is something that we are absolutely going to talk about today. But what I want to do is kind of give you an idea of where we're at right now, how we got here. And I'm going to do that by talking about some of the fundamentals with alternative investments. Okay. It's not just real estate. All right. But I think every alternative investment is going to have like some of the same foundational principles. And then, once we get to kind of like where we are right now, I'm going to pull out my crystal ball and predict the future, right? So that's my goal today. And I can tell you already that I'm like 0% accurate at predicting the future. I get some things right, but I get more things wrong. But I think I'll be able to give you guys at least things to look for, and we'll go from there. So that said, I found a lot of really, really cool pictures online. If you're familiar with Utah and the Wasatch Front, you're probably going to recognize, a lot of these locations. But um, anyway, I think it's probably one of the prettiest areas I've seen in the world, and I've been to 40 countries. But this picture near and dear to my heart. My mother actually grew up a couple of blocks away from where this picture was taken. So this is historic 25th Street in Ogden, Utah. But anyway, a little bit about who I am. All right. So founded Streamline Capital. Streamline Capital is actually a relatively new company. It's been around for 2 years, but it's based on many years of success prior to. And over the last 6 to 8 years, I've been a general partner in 1,600 multifamily units. We've had 9 successful exits, and a couple of years ago, if somebody would have said never lost money, I would have been like, psh, yeah, but what did you give people? But right now, that's really a big thing. Never lost. The projects that I've managed, have not lost money. Okay, so we've had 9 out of 9 successful exits. Average annual return that we've given back to our investors is 19%. Okay, so we've done fairly well. Now, there are a lot of challenges in today's market that we're going to talk about today. But anyway, 19% annual returns, especially in the market today, I think significant. Now, one thing, our focus and why I founded Streamline Capital is basically buy and manage value-add apartments in the greater Salt Lake City metro. Okay. For those who are local, think Wasatch Front. Okay. Anywhere between, I'm cutting it off at North Ogden, all the way down to, Payson area is kind of where we're looking right now. But in the last, it says 12 months. I think we have to expand that to 15 months now because I made this presentation a little bit ago. We've acquired, 3 properties, raised. We just hit the $10 million mark in equity raised, and got another property under contract. But Utah born and raised, Layton High School is where I went to high school, University of Utah, bachelor's degree in 99, master's degree in 2001. And after the World Trade Center went down, I decided to join the Marines, shipped out of the Salt Lake City airport. And basically maintained Utah residency until, I retired. My wife put down the ultimatum. Her family had essentially moved to Idaho Falls, migrated from Salt Lake to Idaho Falls, and that's where I live right now. But that's just real quick background. So what I want to talk about and kind of set the stage is, when we look at investments, I think it is very healthy to compare as long as we're doing apples to apples, okay? And so what I'm going to use as my baseline is the S&P 500, all right? This is, I'm sure you guys recognize this gentleman, the Oracle of Omaha, Warren Buffett. His recommendation for most people is to own an S&P 500 index fund. Okay. Now, why? Okay. Because when you buy the S&P, you're essentially buying all the big companies, in the US. Okay. Now, is it 100% efficient? Is it the best thing in the world? I don't know. But, that's his recommendation. And because there's less volatility when you're investing in 500 companies. All right. Now, I mean, right now we have 7 companies that are really dominating the S&P, but we're going to ignore that for now. The other really good thing about the S&P index fund is it is very low cost. Okay. So now, is this actually how Warren Buffett invests? The answer is no. Out of his, roughly, 300 billion in assets, he only has about 40 million parked in, index funds like the S&P. So, but, nevertheless, for most people, the best thing to do is own S&P 500. Okay. Now, I did a little experiment last week. Right here, I'm saying S&P's easiest investment ever, but I opened a brokerage. I had a brokerage account already, but I opened a brand new brokerage account, and just to see how long it would take me to go from, clicking the first button on the website to have everything set up. Okay, payroll deduction, well, not payroll deduction, but automatic from my checking account. The answer was 12 minutes. Okay, it took me 12 minutes to get on the Schwab website, link my bank accounts, and set up an automatic monthly deduction that was going into an S&P 500 index fund. Okay, and so when you look historically, now, I mean, last 2 years, S&P has been up 50%, over 2 years. But if you look at historically, the S&P 500 average is about 10 to 12%. Okay, long-term average. And the expectations is, even though we've had a couple of really good years lately, over time, we'll probably get back to, that 10 to 12%. Okay. So if you could, with just 12 minutes of your time, achieve 10 to 12%, okay, why would you invest anywhere else? Okay, and so this is kind of like the baseline of everything that we're going to do, and we're going to compare real estate, honestly, to this 10 to 12% average. All right, but if you could, for very minimal effort, get average returns over a 20, 30, 40, or 50-year period of 10 to 12%, why would you invest anywhere else? All right. Now, I'm a real estate investor, but the answer is really simple, is because you can get better returns elsewhere. Okay. Now, this background picture is a property that we closed on a couple of months ago. The type of property that we're really excited about. So, and the other thing about stuff like this is they have historically achieved better returns. Okay. Now, they almost have to have achieved these better returns. But when we look at other investments, there's certain investments that, also come with tax advantages. And real estate is one of those that will come with a significant amount of tax advantages. Um, so let's see. All right. So when we look at kind of real estate in general and these other investments in general, and I think this is true for almost anything in the alternative investment category. And I'm going to go on a little bit of a tangent. I really hate that word applied to real estate. When people are calling real estate an alternative investment, the honest truth is real estate has been the only investment, or had been the only investment in the world for millennia, until 17th century is when the first stocks were actually formed and traded, right? So when you start looking at, real estate, it is the original investment. Okay, so what I'm going to do is I'm going to go over kind of what it takes to put an investment together. Okay, now when we put these deals together, we're looking at properties, ballpark 10 to 20 million dollars. Okay, but this really the same model applies at higher levels. Okay. When we get to higher levels, there are other layers that come in here. But essentially, we go find a property and we get the property under contract. All right. We're also, and all of this stuff is simultaneously. It's not typically sequential. We have debt relationships. We have a lot of relationships with investors. But we get a property under contract, we go out to a lender, and we're typically arranging 60 to 75% of the purchase price in debt. Okay, low interest debt. And then how do we fund the rest of the property? Well, we find investors. Now, a little bit later, I'm going to talk about, big level stuff. We find what we refer to as retail investors. Everybody on this call is potentially a retail investor, individuals that are investing on their own behalf. That's a retail investor. All right. So, when we get a property under contract, I might put in 100,000, and I'm going to go out to a bunch of other people and get chunks of money between, 20, let's see, in the last year, the smallest chunk we took was 25,000. And I think the largest investment was 300. All right. So when we're putting these deals together, we're dealing with, 5 and low 6-figure sums. But when these larger deals come together, they have a separate check writer, people who are writing larger checks on behalf of sometimes multiple investors, groups, or high net worth. But the last bullet, I think, is the most important here. Okay. Once again, S&P 500, 10 to 12%. Okay. There's a lot more work. There's a different set of risks in real estate than in the S&P. So if we put one of these deals together, it only works if the investors are confident that we can beat the S&P. Okay. Otherwise, why would they move their money out of the S&P? Easiest investment everywhere. Set it and forget it. And honestly, if you're a young guy or gal right now, you could set it when you're in your 20s and 30s and never look at it until, for a decade, and then just see, really, really big numbers there. But these deals only work. All right. And we can only find investors if they're confident that we can hit these 15 to 20% returns. All right. So anyway, so that's kind of like the baseline of this. How does this work? And by the way, this works for large developments. This works for people like me that come in, buy existing apartments and fix them up. Typically the same type of structure, just different players involved. All right. So what happens when rates go up? All right. And I'm probably the only one that notices this, but I did reformat everything to have more picture and less words. And I think I opened up an old copy of this presentation, but who cares, right? Incidentally, these are my versions of the Wasatch Mountains. I grew up right in the foothills here. But who cares? All right. So when we look at expenses that we have to pay, rents come in, we have operating expenses, we've got to pay, a lot of bills to keep the property rolling. All right. And in Salt Lake City, we are typically keeping about 70 to 75% of the revenue that comes in. Okay, that comes down to our net operating income. All right. Then after that, we have to pay our debt service. And debt is typically our largest single expense. All right. I don't think I have a single property where I have an expense larger than my debt service. Okay. So when interest rates go up, all right, in general, our profits are going to have to go down. All right. So I mean that's making a couple assumptions. We'll go into different scenarios in a second, but when interest rates go up, our expenses are going to go up. All right. Now, whether or not our profits go down depend on a number of factors, but we're going to have to pay a lot more on debt service. All right. But once again, we still have to beat the S&P to attract investors to our properties. All right. So there's only a couple things that can happen here. All right. How do we do that? Well, if we want to maintain this 15 to 20% return to our investors, okay, one way we can do it is just to pay less for the properties. Okay. We can't, I mean, there's only so much you can raise rents before you're outside of, market norms and people stop paying. Okay. So we pay less for the properties. Now, me, Brian Briscoe, Streamline Capital, we don't have enough purchasing power to really affect the market. But when rates go up across the board and everybody is feeling the same crunch, all right, that leads everybody, on a mass scale to start paying less for properties. And when that happens on a wide scale, the prices go down. All right. Now, I am very much simplifying, the economics behind this, but just to give people an idea of the factors at play. All right. A lot of people have seen this graph. This is the federal funds rate graph. And I mean, you can see what happened, you know, this little down period right here where the federal funds rate was almost zero. I mean, real estate had its heyday. I mean, think prices were going bonkers, but so is inflation. And then, of course, everybody knows what happened. Rates went from, the federal funds rate gives you a quarter point range, 0 to a quarter point up to, 5.25 to 5.5 within, I think, a 14-month period, right? So rates went up fast and furious, and that pinched a lot of people. All right. So this is what interest rates looked like at the beginning of 2022. And I'm going to give you kind of 6-month increments going through here, And one thing I will note, all right, and I think a lot of people don't particularly understand this, is the Fed, the Open Market Committee, controls this left-hand side rate. And that's the only thing they control, okay? They set the federal funds rate, and the short-term overnight rates are based off of that. Okay, when you get to the right side, 1 year, 2 year, 3 year treasuries, 5 years, 30 years, all right, that's all, it's influenced by that, but it's not directly set. Okay, this is more influenced by bond markets and a bunch of other things. So when we look at interest rates with real estate, let me do a little bit of translation and then I'll show you what's going on. Short-term loans, like they're typically referred to as bridge loans, are all based off of these short-term interest rates, okay? Now, these are the type of loans that people get when they're coming in and building or making a lot of changes, all right? So short-term bridge loans typically have variable interest rates. They don't always, but the interest rates are based off of the short-term rates, okay? When you get longer-term loans, the 5, 7, they typically come in the same categories as the treasuries. You can get a 5-year, a 7-year, a 10-year, loan, but those are all based off the treasuries, which are on kind of like the right-hand side of the yield curve. Okay, so different properties are affected by the federal funds rate. Some properties are completely unaffected by the federal funds rate. Okay, so 6 months. This is July of 22. All right, January of 23. And then July of 23, I think I have one more. Nope, that's the last one. And that's about where things settled with the federal funds rate north of 5. And you can see how we had a healthy yield curve to this inverted yield curve right there, right? And that's really what put the pinch on a lot of people. Okay, people who had these short-term loans, these variable rate loans based off of the it's SOFR, not the federal funds rate, based off of SOFR, were really pinched. And people who were expecting to refinance, and the refinances are based on this side of the yield curve. All right, if they were expecting to refinance off of a rate when treasuries were in the ones, and now treasuries are in the fours, that's a big difference on their refinance. And so what really happened is a lot of people who were taking on these development projects, taking on these value add projects, those are the people that got hurt the worst, because they're the ones that had loan terms maturing sooner and were forced to refinance sooner. All right, so what did that do to values? Here's about a 30-year overview of multifamily values. Peaked in mid 2022, and it actually started falling off right after the first series of rate cuts. Okay, we actually had a property under contract when rates started going up, and man, it was a very volatile time. The lenders started pulling back, and our quotes from the lenders were different every single week. We ended up backing out of that one, but just because the debt went really, really crazy. But you can see what happened to multifamily values, peak in 2022. And then, this ends at 2024. I think my next slide has, or anyway, a couple of slides later, we have kind of a forecast, but most of the big think tanks have said that we have hit the bottom already. So prices have dropped on average 20 to 30% across the board. Okay, some metros have been hit harder than others, but nationwide averaged, 20 to 30% decrease in prices in multifamily across the board. All right, so if you're a property owner, and let's say you bought a property for 20 million in 2021, and it went down 25%, and it's now worth 15 million. All right, do you sell? All right, and for most people, the answer is no. Unless you absolutely have to, you are not going to sell. All right, and this has kind of second and third order effects on the rest of the market. Okay, so who are the people that are selling properties right now? The people that absolutely have to. All right, people who are pinched by interest rates, people who are out of cash, people who are facing foreclosure. There's a lot of people that have to sell, and those are typically the properties that we are seeing on the market right now. This one in the background is actually not that case. It was we bought this from a gentleman who was retiring. He'd owned the property for 20 years, and even with the downturn, he still had a couple $1 million in equity in this. But for the most part, that's what we're seeing, is the volume is down. Now, when you start looking at multifamily volume and why that matters, you kind of look at a typical sale. Once again, I'm using a very simplistic model, but I think the power of showing the bigger picture really works. All right. So I'm a real estate owner. All right. If I sell a property today and the property's done well, I am going to get a very large windfall. Okay. A lot of money in my bank account all at once. Okay. So what do I do with that money? All right. It can sit in my bank account and do nothing. Or guess what? More likely, I'm a real estate investor. So I'm going to take that money and I'm going to go out and buy more real estate. Now, one thing that really pushes markets is the amount of cash that goes into it. All right. When the federal government had these stimulus packages in 2020 and 2021, what happened to the markets? What happened to prices? Things went crazy because a lot of money was pushed into the system. All right. And so when you have these transactions, when you have people that are getting these large windfalls and profits, they are looking to reinvest. All right. And those reinvestments continue to drive the markets. Okay. Adds more demand. And that in general will start pushing prices up. Okay. So not only did we have hikes that affected the pinched people, but we have a secondary problem of very low volume. A lot of people that are selling right now, instead of getting windfalls, are getting losses. Um, I've heard a lot of people say they'd be very happy if they can get their original investment back, and who cares about profits right now, because that's where a lot of the properties that were purchased in 2020 and 2021 are sitting at this point in time. All right. Now, it is a much different market today than it was in 2020 and 2021, but that's something we'll be discussing in about 10 or 15 minutes. All right. So you can see there's second and third order effects of these rate hikes that have also affected, in a downward direction, prices. Okay. So next question, and a lot of people ask this, when rates started going down, when the short-term rates started going down, people were expecting the long-term rates to go down as well. But what happened was the opposite. The long-term rates actually went up. We bought a property in August, and at the time, the 5-year Treasury was, I don't remember exactly what it was, but it started with the number 3. All right. This morning, and then the 10-year Treasury was like around 3.8. Okay. This morning, I think the 10-year Treasury was like 4.5. Right. So the right side of that curve actually went up when most people were expecting it to go down. Okay. So right now, we're kind of in that uncertain period. What if these long-term rates don't go down? Okay. Are prices going to continue to drop? Okay. Well, what's really going to happen is prices are going to have to find an equilibrium with the new rates. Okay. The interest rates affect pricing, but they don't control pricing. Okay. But there's going to have to be this equilibrium of new rates. The things that are pushing up on these prices, we have inflation. Inflation is pushing everything. Okay, the more inflation we have, the higher we're going to see real estate prices. But for anybody, for other nerds like me, I have 2 degrees in math and a minor in physics. In physics, we'd always do a force diagram, and we'd point, hey, these are the things that are pushing up. These are the things that are pushing down. And whatever the net result is, when you add all of those forces together, you're either going to get things going up or things going down. Okay. So if interest rates stay at the current rate, we'll probably have a little bit of downward pressure on pricing. All right, until it comes to that equilibrium. But once again, we have inflation, which is going to push values up. Inflation is also going to push the rent prices up, which pushes your income up, which has a secondary effect of increasing value as well. All right. And then there's also still a housing shortage in the USA. If you live in Utah, I mean, the governor is talking about it all the time. A lot of people are talking about, how many housing units we are short of meeting the current supply, and how it's really kind of a David and Goliath type problem, because it's a huge problem nationwide, and that supply and demand is also pushing prices up. All right. Now here's the forecast that I was alluding to earlier, and this one breaks into high supply markets and low supply markets, or high supply markets and nation. And we're going to talk a little bit about these high supply and low supply markets next. Okay. But you can see, you can see the same trend. Prices went up. They peaked around Q2 of 22, around Q2 of 24. Most people said that's where things bottomed out. And the forecast is for prices to go back up. All right. And anecdotally, a lot of the brokers that I've talked with have said that they've started to see an uptick in transactions, and more transactions means more money released. More money released should have a snowball effect on more transactions. So rates, I think that's kind of the effect rates have had. It's added to our bottom line. And once again, we still have to be able to convince investors that we can get that 15 to 20% return, or we're not going to be able to raise the money for the deals that we're doing. Okay. So, and that's kind of the baseline, which really, really affected. Now, in the future, okay, the faster we have relief on rate cuts, the faster the recovery and the faster those numbers are going to go up. okay? Um, but we need both sides of that yield curve to come down, okay, for faster recovery, okay? If rates stayed exactly where they were right now, we would still see values go up. It would just be flatter. The curve would be a little bit flatter or less steep going up. Now, just a couple of observations, and this is true almost all the time. You know, the longer term deals are generally safer because there's more time for that market to go up. Okay. And short-term deals, which is kind of, you know, we like doing a lot of value adds. You need to be able to add a lot of value to overcome the volatility in the market. Okay. If you're only adding a little bit of value and prices don't go up, you know, your profits are going to be compressed a little bit. So the shorter term deals need to add a lot of value to guarantee success. All right. Now, I think now is a good time. We're done essentially with the rate discussion. And I haven't had the questions in front of me. Stephen, have we had any questions hit?
We have had some questions, but we've been able to answer them as you've been talking.
Okay, cool. All right. So nothing for me to address. Is there anything that I should address for people watching the replay? How about that?
That's a great question. So if you go in, one of our attendees was asking about the month-to-month versus the closed ad, the average rate being important to people. So the net monthly income is also important. Addressing one of your points earlier.
Okay. Let's see. Yeah, so every investment is a little bit different. Okay, some investments like we purchased the Eleanor Rigby. It wasn't a value add. It's a downtown Salt Lake City apartment complex. That one has very consistent income. Okay, so when you're looking at investments like this, you know, you can't lump all of real estate into the same bucket. Okay, some of them are going to have very steady income. Others, like when you're doing the heavy value adds, you're typically not going to have a lot of income until the value add is done. Okay. Why? Well, because we are intentionally reducing occupancy in the properties to be able to do a lot of the value adds, to be able to do a lot of the renovations that we're doing. So really, I would just say, you know, when investing in something like this, come to the table knowing what's important to you. All right. Do you want the stable cash flow, or do you want the growth potential that these investments can give you over time? Okay. And depending on, you know, where you are on that spectrum is going to help you find the right type of investments. Okay. Value adds, not a lot of cash flow, but typically have a really high overall return. Some of your stabilized properties, you know, will have more cash flow, but typically a little lower overall return. So there's a little bit of a balancing point. And then Landon, good question. Are we still getting 75% debt in today's market? It depends on where you're at. In Salt Lake City, I don't think 75% debt was even a thing in 2022 or 21. You know, in 2018 to 22, most of my purchases were in the Southeast, when we were routinely getting 80%. Right now in Salt Lake, we are routinely, we're in kind of that 65 to 70% leverage range right now. Other parts of the country, they're probably closer to that 70 to 75, but just because of the dynamics in Salt Lake City, the cash flow in Salt Lake City is also a little bit lower because the expectation of future growth is higher. And, you know, so lenders they're looking more on what's on the paper instead of what the expected growth is, like a lot of the investors do. So Salt Lake, let's see, our Eleanor Rigby property, we were at 55% debt on that one, but we assumed a loan. On Blair Street, we were at 60%. On White Pines, I think we were right at 70. And the properties that we're looking right now in our funnel, you know, lenders are quoting us between 65 and 70 right now in Salt Lake. So All right. Tax advantages can be a differentiator, but I think they're really only going to be swinging the investments unless your portfolio is set up to take advantage of the tax benefits. Really realistically, the tax advantages are really going to swing things a couple percentage points. Okay. Um, I would say don't invest in anything just because of the tax advantages. I think you need to make wise investment choices, and tax advantages are part of the determination. But anyway, all right. So we'll go on to the next one. And for anybody across the country, the question is, have you seen this? And what I mean isn't this specific building. This is on Third West, just north of in Salt Lake City, but you know, have you seen construction like this where you're at? And the answer is probably yes. Okay. In the last couple of years, when interest rates went down, and in this 2021 to 22 or 2000, like post-COVID, you know, rents went up, values went up, interest rates bottomed out. And what happened is a lot of developers decided to pull the trigger on new developments. Okay. So here's what we've seen over the years. The bars are the new supply that has hit the market, and this line is the percent year over year growth. Okay. So what we've seen in 2024 is kind of like the culmination of low rates, high inflation, high rent yields, or rent year over year rent changes. And depending on who you talk with, 2024 is either a record year for new deliveries, or it's the second highest year in our nation's history. Okay, this is multifamily only. So almost 700,000 units were completed in 2024. All right. So when you start looking at, what happened with that, so when a new apartment complex comes online, if it's a 100-unit complex, they're going to have 100 units that they're looking to lease. Right. And because so much supply hit at the same time, you look at the supply and demand curves, not everybody in the market is looking for a new home at every given point in time. And so essentially what has happened in a lot of places is there wasn't enough demand to immediately fill all of these units. Okay. And so you start seeing people put concessions in place. Okay. What is a concession? $200 off of your first month's rent. Okay. First month's rent free. Things like that, where you give incentives, financial incentives for people to rent your property. So the first thing that happens when, a lot of supply hits is they start putting concessions in. All right. If concessions can't fill it, people start dropping rents. Okay. And so what we've seen in especially in the high supply markets, is rents have actually gone down over the last 2 years. They started coming back up in most locations, but we had rents go down. And so when you look at the valuation of properties, the income is a big factor in how much the value of these properties changes. So if your income goes down, your property value also goes down. So compounding the interest rate issue, we also had this surge in new supply hit. Okay. Now, here's rents, and naturally in the US, there are some seasonal variations. Okay. Rents typically go up in the warmer months and they go down in the colder months. All right. Now you can see, I wish I could have found a chart that went back, more years. But I think 2019 was the last normal year we had, where you have, modest increases, and these are month over month increases, modest increases in the summer, and lower decreases in the winter. So in 2019, there were 8 months where rents went up, 4 months when rents went down, and year over year, the numbers went up. On average, rents go up about 3% per year, which incidentally tracks inflation very well. All right. So when you look at what happened to rents, now you have a lot of these. In 2022, you have a lot of these down months and not very many up months, and then a lot more and more significant down months here. Okay. So when you look at the effect of all of this new supply, it has also pushed prices down. All right. And This one right here, shows kind of the difference between, rent growth in the high supply markets versus the low supply markets. And, or excuse me, not rent growth, percentage of inventory with negative rent growth. Okay. So the higher the curve, the larger percentage of properties that saw rents go down. So in the high supply markets, okay, and a lot of these are Sun Belt markets. Salt Lake City was definitely a high supply market, but for the most part, these are your Sun Belt markets, your Southeast, your Texas, your Floridas. All right. So high supply markets almost across the board have seen rent decreases, and the lower supply markets were actually a lot more stable. Okay. So when we look at what's happening on a national basis, it kind of makes sense to split things up into these high supply markets and low supply markets. All right. So when you put these together, rates went up really, really fast. A lot of new buildings went up really, really fast. It kind of gave a perfect storm for valuations, right? And you don't want to be, in that little boat right there in 60-foot waves. You want to be out of that perfect storm. So let's look at what's trending right now. And the different colors from left to right, that sage green is increasing vacancy, negative rent growth. Okay. So when all this new supply hit, new empty units means your vacancy automatically goes up and rents start going down. Okay. The darker green is okay, we kind of got a wrap on it. So our vacancy is now going back down, but we still have rents going down. And then this kind of orangish color, salmon, I don't know. Um, Declining vacancy, positive rent growth. Okay, and this is like where we like to be, where we want to be right now. You see Salt Lake City, where I conduct, where we're buying properties. Whoops. We are already in the declining vacancy, positive rent growth. Okay. So units are being filled faster than they're being built or, or vacated, right? And rents are going up. And then the next stage is, our vacancy stables out and we still have positive rent growth. So what you can see is some cities, like Salt Lake City, for example, is back to the point to where rents are going up and vacancies are going down, which is really, really good for investments. All right. Um, if you own something to the left of this timeline, this period right here was probably really rough on you, but right now we are seeing things go back up across the board. All right. So, in a nutshell, I'm going to go back a couple of slides and look at the forecast. When you look at this new supply expected, it kind of drops off really significantly. Okay, 2025 is going to be an above average year for new deliveries, but 2026 and 2027 are both going to be brand new 10-year lows. Okay, and so 2013 and 14 were actually low years because they were post-Great Financial Crisis and things dropped off. So when you look historically, 2025 is an above average year. 26 and 27 are probably going to be two of the five lowest years in the last 30 years of history. Okay, so when you start looking at what effect that's going to have, we have all this pent up, we have a lot of demand for housing, okay, and that demand's not being met in most years since the Great Financial Crisis. There have been less housing units built than new demand created. Okay. And so we are going back to that. 2024 was one of, I think, the only years in recent history where that trend reversed itself for a single year. But in 26 and 27, we're going to go back to some very low new supply markets. So what to look for? In your high supply markets, you really want to pay attention to that supply versus demand. All right. And the best way to look at that is in vacancies and pricing. Okay. If vacancy rates are going up, occupancy rates go down, that means there's more supply hitting the market than the current demand. Okay. So in the high supply markets, when you see the vacancies start going down, all right, that's the first sign that things are on the mend and on the up and up. Okay. And then, as that big wave of new development gets filled, all right, we should see rent growth going back to normal and vacancy rates stabilizing. Okay, so first thing you're going to see is vacancy rates going down. And then we're going to see rents going back up, and then you're going to see things stabilize and hopefully go back to normal. All right. In your low supply markets, a lot of your Midwest cities and your northern cities are low supply. They haven't seen, a lot of the rent declines like some of the high supply markets have. Okay. And in these types of markets, I mean, traditionally, these are markets where you have more cash flow, where you have less appreciation. And because of the lower appreciation year over year rates, you didn't see as many developers, try to really get into these markets. The developers were all hitting the markets where they were expecting high year over year growth. Okay. And those are the markets that tend to have more appreciation than cash flow. All right. So my prediction for the future, and, I mean, I have learned that if I make predictions very broad, I tend to be righter or less wrong. But I think, and once again, this is very much location dependent. Okay, speaking of Salt Lake City, all right, I can confidently say that we've reached the bottom. All right, now. Have we started going back up yet? One thing with the data here is there is a lot of latency. Okay, we are not going to be able to tell if we've come back up for probably 6 months. All right. So it's one of those things that you're looking back at, and that's when you can clearly see whether you've hit the bottom or not. Okay. Most of these big think tanks have said that, nationwide we've hit the bottom, and Salt Lake was ahead of the recovery curve in the high supply markets. So we've hit the bottom. All right. And we should see several years of sustained growth. If you look at real estate over history, in general, you're going to see periods of 10 to 15 years where prices are very steadily going up. And then you're going to see a 1 to 3 year period where prices go back down. And then you get things going back up again. Okay, that pattern has held for over a century. And my expectation is that pattern is going to continue. All right. How fast, the prices go back up is going to depend partially on what happens to interest rates. If we see some relief, like I said, both the right and the left side of that yield curve, we're going to see the prices go up a lot faster and bounce back a lot faster. All right. Typically, high growth markets are going to see the biggest gains. Okay, but we have to get that big supply chunk, filled before that's going to happen. All right. And the high growth markets have typically been the high supply markets, but the high growth markets are where, when we look at the pinch, when we look at the low deliveries over the next 2 to 3 years, the high growth markets are going to have more population growth and they have new product coming online. And that's what's going to fuel the growth. It's going to fuel growth in rents, and it's going to fuel growth in prices. Okay, so they're going to see the most growth, but they're also going to see the most competition. And typically that competition tends to be an equalizing factor when you're looking at returns. All right, the low growth markets are probably going to have steady, consistent returns. Okay, so what are you looking in high growth markets like Salt Lake is, maybe not a very strong cash flow play, but in 2 to 3 years or 3 to 5, 5 to 10, whatever your hold period is, you should see a very large appreciation number, and most of your returns are going to come at a sale or, a refinance or recapitalization. All right. In the low growth markets, you're not going to have as drastic increases in pricing. And these are the markets where lenders typically give you, a little more favorable terms, and you can cash flow a little better. Okay, so that's what I see coming up in the future is getting back into that 10 to 12 year phase where prices are going back up. And one thing that's really nice is we are buying compared to pricing in 2022, we are buying at a 20 to 30% discount. I remember talking to the owner that we bought one of our properties from. We paid 10 million for this particular property. And he said in late 2021, he had an offer on the table at 13 million, right? So, if in 21 he got 13 million and we picked it up at 10 million, eventually the prices are rebounding. The prices are going to go back up. Eventually that property is going to hit that $13 million mark and keep going. But, if we're looking at timing for investments, we've got a couple years of low supply, okay, low new supply coming. And, you know, we're pretty sure rates are not going back up. Who knows about that one? But we should see several years of good growth. So that said, let's see. I'm going to open up this Q&A thing really quickly, see if there's anything else. All right.
One question, Brian, that was not
Yep.
in the Q&A was some of the attendees have asked if they can get copies of some of these slides.
Yes, absolutely. So what we're going to do, if you registered, well, if you're on this call right now, you've registered. We will send a video link of this. Stephen, I'll give you a link to the actual presentation itself so people can pull the presentation up. And Landon threw a question in there, and Stephen answered it. All the data in here, one or two of the slides were CRE in general, commercial real estate in general. All right, I think the one curve that showed the peak and the valley, that was a commercial real estate. I want to say everything else was multifamily specific. Okay. The same trends that are affecting multifamily in both inventory and interest rates have affected most of the other commercial real estate sectors as well. So office is an outlier post-COVID because offices almost emptied out completely. But yeah, so the price curve I think was a generic commercial real estate one. All right, so what you see on the screen right now, QR code. If you want to talk to us about our investment opportunities, pull out your phone, scan the QR code. It's going to take you to a form that you fill out. Once you fill out the form, we'll send you a link to get on either my calendar or Stephen's calendar. So, and just have a quick discussion about, more in depth about what we do, what our offerings look like, and how you can get involved in those offerings. That said, I'm once again pulling up the Q&A, seeing if there's anything else that I want to address. I think everything was good. Any other questions? I would say, speak now or forever hold your peace. I do want to keep this to an hour, and we are at the 55-minute mark. So we probably have time for one or two more questions. But in the meantime, once again, if you're interested in discussing more along, how our investments could potentially work for you, scan that QR code. Fill out the form. Yes, we are going to be asking you for an email address. That's how we're going to send you the calendar link to get on our calendars. But scan the QR code, fill out the form, and we'll hop on a call. Especially if you're in the Salt Lake area, we do tend to have events for investors. We're planning a Top Golf outing coming up soon where if you're interested and have the potential to invest, we'll take you out golfing with 10 or 12 other really, really cool people. But and we do have lunches around the valley as well. So periodic lunches where we foot the bill. We had one at Capitol Grill recently. We had one at Stephen, what was that? What's that Mexican? It's 6 South and
Sol Agave. Sol
Sol
Agave.
Agave. That was a really good one as well. But we tend to have events like that. So if you're in the Salt Lake City area, definitely reach out. How many deals do we have available in Salt Lake City right now? For the general public that we can advertise, we have one, right? And it is a 506C investment opportunity, which means accredited investors only. Couple of the pictures on here were actually that investment opportunity, but we do have one available in Salt Lake City. Minimum investment, 50,000. And actually, I'm eating lunch with our general contractor in about 30 minutes. And then we are going by the property. We own the property already. We're still raising for our renovation budget, but we're going to the property after lunch and we're looking at our brand new storage units for the tenants, which one really, really great way to boost revenue. All right, so we are at the hour mark roughly. I didn't see new questions. We will be sending out a link to this presentation. Oh gosh, I hope we recorded it. It is set up for automatic recording, right? All right. Yeah, we are recording. Good, good. We are recording. So we will send out the recording. And since people have asked, we will send out the slide deck as well. All right. Thanks, everybody, and see you all laters.